Hello, everybody. Welcome to Monday. The S&P 500 was up 0.64% today, kind of extending the rally that we started on Friday. Actually up about 2.75% in total from that point in time. So if you looked at, when the market closed on Thursday, the relative strength indicator, which is one of the measures that I use to show how much a market is stretched one way or another, was below 30. So it stretched way down. Whenever it's below 30, if you go back, you can see a lot of really good buying chances, at least in the short term, where you kind of get a bounce off of that stretched, oversold position. And certainly saw that on Friday, a big jump upward. It's nice to see a second day. That's actually a really big deal to see 2 days in a row of positive markets. Generally speaking, you'll see some follow through from that. We had the Treasury Secretary, Scott Bessent. He was a hedge fund manager for about 35 years, so he's got a very good sense, obviously, of what's going on with the stock market. Talked about how he really wasn't worried about the stock market, that these corrections, these 10% downturns, are healthy for the market. It's the same thing I've been saying for a long time, too. Sometimes you have to come down to go back up, especially when you're in an overall bull market, which we're still in. 50-day moving average is still well above the 200-day moving average. And, we have set a lower low finally. We haven't done that for a couple of years, but really, the market is still in an upward trajectory. The primary direction is still up. So 10% down, if it doesn't turn into something a lot bigger, actually can be a really good thing. So obviously there's been a lot of concerns about the tariffs and those types of things, but Besant was talking about, if you put in good tax policy into place, deregulations and good, energy policy, the stock market will really like that. And, not all of us like that personally, but the market definitely does like that as a whole. So we'll see how this plays out. And I think the market's going to kind of hang in there to see how that happens. We are in this kind of gap period between all the things that they can do that the market doesn't like versus all the things that they can do that the market does like. And those are still coming. And so that could create a good situation. And as I mentioned on the show on Friday, going back to 2004, November and April are the two best months of the year. They're tied actually with each other. And so here we are heading into April. So there's a seasonality kick that should come in here also, might get us a little run. The key with this, if you just get a little bit of a bounce and it's kind of weak, you're going to see it come right back down and probably test some lower lows from where we are at. But sometimes you get this, movement upward. You get the short sellers kind of panicking and starting to cover their positions, which means buying back their stock. And sometimes you'll see the quant, programs start to come in and buy, and you can get these big run-ups that happened. And that's what happened back in November of 2023, in my opinion. According to Goldman Sachs, most of the downturn sales that came through in this 10% downturn were actually from these quant funds. This is computerized trading programs, and they were selling. Again, the only good thing about that is that they can turn around and start to buy and drive things right back up again, too. So we'll see what happens here. I'm going to be a little bit cautiously optimistic, only because, with the tariff policies out there, it's a little bit hard for the market to kind of overcome that. I did read a lot over the weekend, and it seems like actually that what we should really be more concerned with, and the Federal Reserve should be more concerned with in terms of, slowdowns, might not be the tariffs, because, first of all, they can go away. They might not have as big of an impact as everybody thinks, like what happened in 2018, but it's much more so the cutback in government spending. Besant did talk about that kind of this concept of detoxing, the overall economy off of government spending. And if you look back at a lot of the job reports, a lot of the jobs that were added were government jobs. And so you continue to add government spending. It makes the economy grow and look pretty decent. But, obviously that's costs money in terms of extra taxes. So the thought process that they're trying to accomplish here is to kind of downsize that overall spending. I wish it was done in a more methodical manner personally, because I think that would be a little bit better for the consumer and the business to be able to find some, less chaos in this environment. They might be more willing to go out and do things. So again, we have seen surveys showing that the consumer is, worried and such. But again, I haven't seen a lot of correlation between the surveys and what the consumers actually do. So, looking at the different consumer spending reports as they're coming out, I think will be important. We've got the Federal Reserve meeting. We've got, the PCE inflation report that'll come out here by the end of the month. And so we've got some pieces to take a look at to see, how things are going as far as inflation and the economy and those types of things too. So look forward to being able to see what's going to happen tomorrow. And we'll talk to you then. Thank you very much.